Okay, in this video we're going to be looking at public companies and looking at how the share market operates. So some of the things we're going to look at is the difference between the primary and secondary market for shares, what shares actually are, what do they mean, why do companies go public, and what is meant by the term dividends and capital gains. And we'll just finish off the video by looking at some factors that influence share prices, causing prices to go up and down. So first of all, public companies, some of the key definitions of public companies or key features of public companies is they need to have at least 50 shareholders. So minimum 50 shareholders to be a public company. Shares can be bought and sold by anybody. So to be a part owner in a public company, you just need to buy shares on the Australian Stock Exchange. And it's basically all you need is enough money to purchase one share and you're a part owner in a public company. So public companies, anyone can buy shares in a public company if they have enough money. They're run by a board of directors. So a group of people, generally towards 10 or 20 people, will meet together and run the company and manage the company. They are listed on the Australian Stock Exchange, and we'll talk about what that means a little bit more in the video, but basically that means that anyone can buy and sell them. And they will have the word limited after their name. So you'll see the words BHP Billiton Limited or Telstra Limited or Phaestra Limited. That basically means that they are a public company. So in terms of control of public companies, okay, a publicly listed company means that shares in that company are available for purchase on the Australian Stock Exchange. And in order to have control over a public company, you need to have more than 50% of the shares in that company. So unless you have 50% of the shares, you only have part control. You can't make any decisions without everyone else sort of contributing to those decisions. You can only make decisions by yourself if you have over 50% of the shares in that company. In terms of advantages and disadvantages, if you were running a company and you were considering taking that company public, some of the advantages would be that once you invite people to buy shares, you have limited liability. So all the owners of a public company are the shareholders, then all they can lose is the value of their shares. They can't be forced to sell their house or sell their car and so on and so forth to pay for the debts of the business. The worst thing that can happen is if you buy shares and say they're $20 a share and you buy $2,000 worth of shares and then suddenly your shares are worth nothing. That's the worst situation that can happen if you invest in a public company. Another advantage is that you can raise a lot of money. So because they're public and anyone can invest in them, it basically allows the companies to make lots and lots of money because you can get funds to run your company from a whole range of different shareholders. So for example, when Facebook went public, they raised billions and billions of dollars that they then had to use to grow and market their company. Investors can sell shares whenever they want. So if you invest in this public company, you can sell your shares whenever you want to. Some of the disadvantages is they cost a lot of money to set up because of the size of them. There's strict legal requirements that they must meet, so there's a lot of regulations that they need to meet to make sure that they don't get closed down. And often it can be very hard to have a say when you're a part owner in a public company because there are so many owners. There's very little say during the year, and often shareholders really only have their say during the annual general meeting. So if you've got a lot of shares in a public company, you might go to the AGM and have some thoughts on about how that company should be run. In terms of what is meant by a share or a share or a stock basically means that you're a part owner of a company. So if you buy a share in McDonald's or Facebook or public companies in Australia like Qantas, that means that you are now a part owner of that company. And the reason that the company issues those shares is so they can raise money for their business. So anybody that owns a share is a part owner in that company and benefits if the company make a profit. So BHP has around 500,000 shareholders. If BHP's profits increase, their share prices are likely to go up and they will make what we call a capital gain. Two markets in the share market. We've got both the primary market and the secondary market for shares. So the primary market is when shares are sold for the first time. So the issuing company goes public for the first time and they sell shares to investors. So if they want to raise money, what they can do is they can allow other people, basically they're inviting other people to be part owners of their company. So rather than owning the company just by themselves, they're asking other people to invest in their company so that they will give them money, and the return on that is that they're now a part owner in that company. So the primary market or the initial public offering is the initial selling of shares to customers when a company first goes public. They call this initial public offering, and they sell a certain number of shares to the public for an agreed price. So it might be $2.20 a share, for example. The aim of initial public offering is to raise funds to grow the size of the business. Okay, so by listing on the share market, the company is saying, if you give us some cash, we will give you part ownership in our company, and as proof of your ownership, we will provide you with some shares. And now you are a part owner in that company. The secondary market is one where customers or consumers or shareholders trade with each other. So investors or traders in public companies will trade with one another. Some people will buy shares, other people will sell shares, with the idea of trying to make money. So you're not buying new shares in the company, and the company isn't really involved in the transaction. You're just trading, one person's shares is trading their shares for somebody else. So the trade previously issued securities without any involvement by the issuing company. So if you buy shares in BHP Billiton Shares, the company itself is no way involved in that anymore. They were only involved with the initial public offering. Now you're just trading with another person, with another shareholder in that company. If lots of people are looking to demand shares, and there's lots of demand for shares, prices will go up. If lots of people are trying to look to sell their shares, then prices will generally go down. Okay, so the main difference is in the primary market that firms sell or float new shares to the public, so they're actually issuing shares. So they might have had 50 shares in their company. Now they've decided to increase the number of shares to 2,000. Where in the secondary market there's 2,000 shares available, but they're just being exchanged between different people. The initial public offering is often occurs when a private company decides to go public, and therefore it decides to list on the Australian Stock Exchange. Small companies looking to grow will often use an IPO to generate more capital and to grow the size of their business. Although further expansion is a benefit to the company, there are both advantages and disadvantages when a company goes public. We'll talk about this in the next video.